EMFR model, if price is coming back down, it did not mitigate this, it is coming in, did not mitigate, it mitigated here. So this one, price opened up here, this bearish candle. Price opened up here, took the liquidity, came all the way down and closed at this point. So whenever you see a sharp move, so for example, when you have buyers trying to push the market up, but then immediately sellers come in aggressively and break some sort of a structure, that is when you would call it a zone that I would be interested in, because a lot of market activity has happened in the zone. I would be 100% interested in the zone. It is a sharp move up with immediate move downwards, right? Which has broken some fractal or some structural area. So always ask yourself, if I'm interested in this zone, what has this zone achieved? What has this zone done, right? Okay, fine, it is a zone, but what has it done? I could say that it went up aggressively. It was trying to push up. Sellers came in and dropped the market aggressively, and it broke a structure over here. So once it breaks structure and there is some fair value gaps, a lot of people tried fair value gaps. I don't necessarily do the fair values. I want to keep my trading as dog shit simple as possible, because I love my mental health. I don't want to be glued to my screens all day long looking at every candle. I just want to be in 2 hours in the morning, 2 hours in the afternoon. If I get one trade win, I don't even look at the markets, because I am looking at 10 years of doing this, right? So a lot of people trade fair value gaps. I just don't want to add another complexity in my trading where I'm looking at one more variable. So, but it is a valid point. If there is fair value gap and you have a structural break, this is a zone that I'll be interested in. So what happens next? So if you look at my crosshairs at this point in time, this right here, where my crosshair is at this bearish candle, this is where the new candle starts printing, right? So this part over here has already printed, this part, and this part to the right is starting to print. So there are a couple of things that I do immediately. First of all, I'll mark out all the zones that I want to trade in the first 15-minute trend. And I will also mark out any liquidity points that I'm interested in that they should go. And once I've marked out a liquidity point, the next thing I will do is I'll wait to see if there is a zone behind the liquidity that the price can mitigate to, and then get a reaction from them. So these three things I do. Immediately define my zones in the first 15 minutes, immediately define my liquidity in the first 15 minutes, and immediately define to see where the prices can trade from. That's it, right? In fact, even two things: define the zone and define liquidity, right? So once I see price action, which is like this, there is no zone. The zone is very high, but if I go up there, there's no liquidity. Now, when I see price action like this, every candle of 1 minute becomes 1 hour long, because I'm just waiting for that 1 minute to pass. Typically what I will do is then I will start looking at if there is any supply and demand being developed within this the second candle. So in my case, this would be a zone, because it had a pullback and pulled up and it broke fractal structure. It was a sharp movement up, and I will draw the zone, right, as such. Now, the next thing I do is that I'll wait for the price to come back. Unless there is a clear pullback, I will then move my zone upwards. But this is a clear zone to me. Nobody is going to debate that this is not a zone. It is a zone. Now, as price is moving up, the next thing what I'm doing is I'm waiting for the price to come back into the zone and give me a reaction from the zone, right? If price immediately breaks through, then I will reanalyze exactly to see what is happening. Maybe there'll be new zones then that'll develop. And we have an example where there were 3 different zones developed within the same candle, second 15 minutes, 3 zones developed, supply demand, it reacted from each other, created another supply demand, reacted from each other, created another supply demand till it went, right? So that could happen. So I'm waiting now for price to come back into this and react from this, right? So I want to see a push away from the zone. Once price started coming back, I did not see any candles touch into my zone, so I need mitigations of my zones. Once I had that mitigation, now I am all laser focused on this, and I'm looking what is going to happen. This candle could have turned bearish and could have given me a deeper pullback and could have reacted a little deeper, right? But it did not. It reacted right from there. So now I'm looking at where is the price going to, where is it next going to mitigate from. For me, it was very clear. This right here. And maybe this is something that I can cover in the next team up, because wicks and the candle theory is very, very, very important to understand. Why am I selecting a wick, or why am I selecting only half a body and not the entire body, right? So for example, why am I looking at wicks, right? What is the purpose? Why am I looking at this? Why am I looking at this wick? Because wicks typically on lower time frames are order blocks, and order blocks is what? You have a sharp move up and then you have an immediate sell, or you have a sharp sell and then you have an immediate buy. So if I were to go to 15 seconds, and this is what you see here, right? So this was a wick. Remember, this right here, this small little tiny thing was a wick right here on the 1 minute, right? This in itself, this, because it's a large one, this is also an order block, or a zone where price goes up and immediately falls down, right? See that? So that would be, for me, that would be definitely a zone. If I even go down further 10 seconds, let me see if it goes. Now you see, a concept of sort of order blocks building up. If I go to even 5 seconds, look at this. So within 5 seconds, you have a buy and then you have an immediate sell. This is the 5 second time frame. So wicks for me are very, very important, because typically price will react from these wicks. People usually draw full candle bodies and react from anywhere in the candle bodies. But the wicks on the top and the bottom of the candles are very, very important for me, because they hold the key of order blocks, typically which price will react from, right? So let's go back to 1 minute and I will show you one more thing. This price action. Just this box. Typically, a lot of people will stay away from buy to sell wicks, right? For me, it is one of the most important zones on my charts. Yes, I look at full body candle closures. I will look at these zones. But if a price is reacting from one of these, so for example, if this wick did not go past this zone, the top of this red box, past this zone, and into this fair value gap, it just stayed within it, I would have placed an entry as a stop order right below this, because for me, and if it took liquidity somewhere on the side, for me, this has mitigated a very, very valid zone. So why do I place a lot of value on this, right? Because on lower time frames, these are actual zones. These are full body candle zones. And since we are trading 1 minute time frame, the 1 minute does not allow me to have enough flexibility within those 15 candles that it creates beautifully structured zones for me with full body closures. You will get opportunities like this, which I'm very, very happy to trade, and I will take you down to lower time frames. For example, look at this. You have prices coming up and it is a clear pullback and then a price drop. So wouldn't you classify this as a zone, as a full zone? Assuming this is 15 minutes, so don't look at this right now, yeah? This is a test for your eyes. Imagine you don't have view to this. This is a chart that is presented. Wouldn't you call this a full body zone from sell to buy to sell? And then you would have optimized your zone till this point. Wouldn't you have done that if this was 1 minute or 15 minutes? Of course you would have, right? This is exactly what is happening. What I am trying to look at, visualize, is what is happening on my lower time frame with the way it is being presented on the 1 minute chart. And I am definitely interested because it is a clear pullback and then push. So buyers wanted to push the price up and the sellers won and it broke down to the price. So now coming back to the EMFR model, if price is coming back down, it did not mitigate this, it is coming in, did not mitigate, it mitigated here. So this one, price opened up here, this bearish candle. Price opened up here, took the liquidity, came all the way down and closed at this point. I'm like, fantastic, okay, maybe now it's coming to my zone. The next candle opens up here, goes down, and then closed bullish. I was like, fantastic. Now the price is definitely giving me a reason that it is reacted from this zone. Once it reacts, my next question is, where is it going to react next from? So this one is already mitigated. What is left? Left is this, and we already saw this is an order block on the lower time frame. So price, then what happens is, if I go one candle, Look at how perfect mitigation that is. Look at that. It just mitigates this perfect wick, which is an order block on the lower time frame, mitigates it and aggressively pushes away. I had already placed my stop order at the bottom of this. I'll tell you why. Because if this demand zone is strong, meaning it has enough orders to push price up, meaning it has enough buyers for houses or mangoes or whatever have you, if I have enough buyers, the buying power should increase the price, right? And it will create a new higher high. But if the buyers are not there, then this level will fail. And if this level is failing, I want to be involved in the breakout trade of that failed level. So that is a failed reaction. That point did not do its job, it failed. And then that's why I got involved into that trade, right? So typically I would place my stop loss at the top of the zone, not at the top of the reaction. In the past, I used to place it at the top of my of the reaction, right? So where is it going to react from? But it's better and more comfortable mentally also to cover the entire zone. And look at that, it's a 2.4 pip stop loss. This is how you get into those extremely SMC driven social media that look at me, I caught the best trade of the world. This is how you get into it. And I would never advise any of my students to get into a 4 pip stop because your commissions are very high. And if you have the wrong bias, you will be immediately within seconds blown out of the market. And then you will want to revenge trade. Keep a minimum of 3, at least 3, and that is what I do. This way I know I have protected my zone here, and I've also protected my wick, the top part of the wick over here, because this could be liquidity sweep. So this low broke, this high broke this low, and then it got swept, and then it gave me a reaction, because all this has happening in the second 15-minute candle, guys, right? All of this action that I'm just talking about is only in the second 15 minute. And to many, I'm really dissecting this for you guys. For many, this is just noise. But you saw how step by step you can tell where price is reacting from, where is it going, where is it potentially going to react from, what are the zones. Put your stop loss above the zone, put your stop order at the failed reaction, because your bias is bearish, right? If your bias is bearish, I want to continue in that bearish direction, and I have now enough evidence that price created a zone, it pulled up, price tried to come to the zone, it did not, went into mitigating this wick, the order block in this. So typically I would draw the full wick, obviously. We went to the lower time frames, that's why it was a little higher. It went in, and then from there on, this is supply. So it aggressively pushed down, came into this zone. The next candle pulled a little deeper and then pushed away from it, meaning this zone is holding. Now, if this zone was holding, it should have printed bullish candles all the way, creating a new higher high, but it did not. It went into this zone, the order block on the lower time frames, mitigated that wick and gave me a solid reaction. So there are a couple of ways you could have entered this. You could have waited for how this reaction looks like and entered right here. Placed a stop loss like this, you're still at 3.5. You could have entered this at the breakout of this as a failed reaction. 2.4 is too small for me, and I could have done this, which is what I did. And you just ride that trade down all the way. So where am I looking at this now? This is the trade. Now people tell you, right? Oh my goodness, I had a 100 pip range and 100 pip trade. This is one of those trades. I had a 3 pip. Imagine it's a 2 pip. I went all the way down to, of course I did not make this, nobody does. That's a 23-hour trade right there, because you were able to get at the wick of the following candle. You just got that top edge and you ran that entire day down. You could hold it if you have balls of steel, but I would have never done that. Any questions, guys, here? I think we covered a lot of topics quite in depth. Hi, David, tell me.
No, a very good detailed explanation. I understand. Thank you very much.
Absolutely.
And I just wanted to add that what you mentioned in the beginning is also very true. Importance of developing a simple edge and then good money management, good psychology, and practice, deliberate practice until you become an expert in your edge,
Yeah.
and something that you could do day in and day out. And I think that's the key.
You are 100% David, and I applaud you for saying this, is because I think a lot of us traders who are entering into the market, and even some old timers, they really suffer from this constant optimization. I mean, you have a wheel, right? Let's imagine a wheel of a car or plane. How much more are you going to optimize a wheel? How much can you scientifically optimize a wheel? You can optimize the material, the tires for Formula One versus rally wheels, but it's a freaking circle, right? How much are you going to optimize it? And is that effort of optimizing constantly enough to give you the returns in relation to the effort you're putting in? So, in other words, what I mean is marginal returns. You're putting in hell of a lot of effort for that 0.01% improvement. Is it worth it, right? Is it worth your mental health? Is it worth you sacrificing your time from your family and away from your kids, just constantly glued? The reason why we do this is to get free time. And if you're sacrificing your free time to get slave to another job, then it's not worth it. And keep things simple as they can, because simple is repeatable. And if you constantly include another variable, let me try this, people forget our job is not to win every trade. It is not. I'm sorry. Our job is to have a slightly above 50% edge. And if you have a slightly above 50% edge, you are profitable in the markets. You will pull money out. If you're 60 or 70%, you are banking it, man. You are the king, right? But often it becomes boring. And when people get bored and you have a new flashy video on YouTube or somewhere else comes in with their Instagram stories, you start reevaluating, should I trade this, should I not trade it? It gave me a bunch of losers. So what? You have 100 trades behind you that told you 97 are winners, right? And I think that's the mental psychology that we all battle. I battled with it. But I recognize these things so fast now that I'm not even interested. So if somebody on Discord tells me SNR or some other keyword or some other industry acronym, I'm not even familiar, because I don't bother looking at anything else, because I don't want to mess up my mindset, my eyes, my edge, because I know what I'm looking for. And if I can do that repeatedly for another 10, 15 years, I'm good to go, man. Oh, good. Excellent, man. I hope you guys had some good value on this. Look at this. This was my trade today. Today is what, 15th, yeah? So, and I posted this. You have clear liquidity taken right here. Template, 1 minute dollar. And I traded from this zone right here. And it gave me a reaction. Look at how that perfect reaction was from that tiny sell to buy wicks. Look at that. So at this point in time, I'm thinking this zone is holding. I placed my buy stop order and just placed my stop loss below the zone. It's all good for me. And I know this does not bother me, because I've seen a million times this play out. Today, did not. Oh well, move on. All right, guys, if nothing else, then again, thank you for joining. I think this adds a lot of more value to me as well, because the more I talk about this, it only re-cements some of the concepts that I've been already doing, right? So you always need that self-coaching as well, and you guys help me a lot in that. So thank you. You guys have a fantastic time whichever part of the world you are, and I will try to upload this maybe in a day and two, and send you all the links. All right?
Okay. Thank you for your time. Very much appreciated.
No problem, David. You take care, guys. Ram, take care.
Okay.
Bye-bye.